welcome.
Thanks, Victor.
Very good to see you. We have a chance to pick Jim's brain on what he's thinking about. Now, Jim, I always think of you as a top-down investor. I'm not sure if you would agree with that. But I do sometimes think of you in your spaceship looking out of the porthole on planet Earth. I hope it's not one of Sir Richard Branson's spaceships. But when you look back at the total global picture, we've got a war going on, which, as you so rightly said last year on this very stage, nobody really knows how that is going to pan out, and it's still quite unclear. We have geopolitical rivalries, we have a lot of tension, we have the prospect of a possible recession globally and regionally. We have inflation, which is still not tamed. We have rampant advances in technology, of which we're going to talk about two particular fields in which you're invested and where you have expertise. I just wonder, since last year, are you more hopeful or more fearful about the outlook for planet Earth?
Planet Earth or the stock market? I mean, if you look at the Master Investor show, look, I think there's great opportunities for us to make money. Last year, we made money despite everything. And I think we've got to be very careful. I'm going to talk about some of that today. But we've got, in my opinion, some of the greatest opportunities in history if we take advantage of them. And so that's why I'm so glad to be speaking with Victor today, because Victor is our best writer at Master Investor. I hope many of you read his things. He's written about the coming sort of fall in electrification in yesterday's Master Investor. He is a really erudite fellow, and it won't be a one-way street, this. I'm going to be asking him questions. He doesn't know which ones yet, but it's going to be a two-way conversation. I'm very, very grateful that Victor is doing this today. We've got some slides, and then there are other slides that will be made available to anyone who wishes them by a process, I guess, of registration. I'm not sure how, but just ask the Master Investor team. So we've got about 35 slides prepared by myself and by Anthony Chow, long-standing colleague, who made a brilliant presentation on agronomics earlier on. And so when you started just now, Victor, it was fairly gloomy what you were saying. And then you ended up with, and we've got technological advance. Well, I'd like us to focus on the technological advance because this is how people will really transform their portfolios. In the long term, that's how you will really make big money. But in the short term, we all have to eat, and we do need to position our portfolios to be correctly aligned with the times. And I just want to show you, if I may, Victor, see if this is coming out. This is one of these silly legal things. I want to show you a couple of slides. This is the world as a football. And as you can see, notwithstanding all the talk about how China is about to overtake the United States, the US is still a quarter of the world economy. The US is likely to go into recession by the end of this year. But the good news is that we probably won't in the UK, and I'll talk about that in a little bit. But you can actually see how dominant in terms of the world economy the US is. And I've been in fund management one way or another for a long time, and it was always the case that if the US caught a cold, the rest of the world got pneumonia, and it's still more or less the same. So we have to watch what's happening in the US very carefully in positioning our investments, and hence the opportunities that I'm going to present to you. And I'll just show one more slide before you get back into your questioning mode, Victor. But I want to show you what we did right in the last couple of years, because it's very important for you at Master Investor to know that myself and my colleagues get up at 5 a.m, Victor included, I know, because I'm sometimes emailing him at that time, and we're reading all the stuff that you don't need to read. And we're coming to conclusions that hopefully will be helpful to you in your investments. And this is all for free. This is a pro bono operation. We don't make any money here in Master Investor. We do it because we want to democratize investment for everyone, and we want everyone to have an opportunity of making the most of their hard-earned savings. So what did we get right in the last couple of years. First of all, negative on growth stocks. Admittedly, I was a little bit early on that, but in the last year, they have done generally very badly. They've done much better in the first quarter of this year, but they're going to do badly again by the end of this year, in my opinion. And we were very long on the value stocks, things like Lloyds Bank, Tesco, the mining companies, the oil companies, etc. I still think that that's the best positioning for a portfolio, is to be longer value stocks and not so long on the growth stocks. I have, for the last 3 years, banged on in here about get out of bonds. When there were $13 trillion worth of negative interest-bearing bonds around the world, I knew that that was an absolute folly. And I hope some of you took the advice, and I hope some of you got out of the bond markets. The bonds have been the worst performing investments in the last 2 or 3 years because they were sillily overpriced. And as a result, you're now seeing banks in the United States, for example, sitting on portfolios of government bonds that they bought at almost zero interest, and in some cases negative interest. And of course, what's the result of that? The banks don't have enough capital, and you have runs, and you've had Silicon Valley Bank, which most of us had never heard of before it happened, Signature Bank, and there will undoubtedly be some other financial institutions that will be affected by the purchase of these long-dated assets at the wrong price in the last 2 or 3 years. Hopefully, all of you got out of it, and you sold on the recommendation. The second thing is that last year I forecast that the UK economy would do quite well. And indeed, it turned out to be the fastest growing G7 economy in the world, with more than 4% GDP growth. This year, despite the IMF and despite the army of forecasters forecasting that the UK will be at the bottom of the pack, we're going to do better than that. We may even be close to the top of the pack in terms of GDP growth, so do not be too negative. And despite mistrusts and Kwasi Kwarteng's budgetary shock at the end of last year with the LDIs, which again no one had ever heard of until it happened, the British pound has rebounded incredibly strongly. So it went from 104 to 125 as of Friday. And our economy is not nearly as bad as people think, though there are plenty of things, including something that Michael Patterson pointed out to me earlier, like tax reform, that need to be done here in this country. But slowly, the ship is righting itself, and the opportunities in the UK market are greater, in my opinion, than in other developed markets. And we'll talk about that in a minute. And then the last thing that we got right was where are we? Maybe we didn't get anything else right. No, interest rates going up and the dollar being overinflated with the potential now for the dollar to fall quite dramatically. So that was what we got right. And it's important that we have a scorecard here, because you're not going to come back if we're telling you the wrong information.
Well, Jim, you foresaw, and it's something I was banging on about for a long time, that the era of zero interest rates was going to come to an end at some point. And historically, it's an anomaly. It's never happened before. And it came about due to all kinds of macroeconomic factors which were unique and precipitated by the financial crisis of 2008 to 9. And we all knew that at some point when rates started to creep up again, that bond prices would start to fall. And yet, a lot of these institutional investors were exposed to this. And then we found out, as you mentioned, about these structured vehicles, which had been used by pension fund companies who have to maintain a certain amount of their assets in government securities because they write annuities, or they have an annuity book, and they must match their assets and liabilities. So I suppose some people couldn't get out of bonds. You foresaw what's next in the bond story? Where do interest rates go from here? Where do bond prices go?
Well, the real interest rates in the developed world, in the US, the UK, etc., are very negative at the moment. In other words, interest rates, given the inflationary pressures, in real terms, we should be having higher interest rates, but we're not going to have higher interest rates. I think the monetary tightening cycle is probably coming to an end because the Fed, the Bank of England, the Bank of the European Central Bank, etc., are very frightened of the implications for high unemployment, for economic recession, and for corporate profits, which, by the way, are beginning to fall sharply in the United States. So we are probably going to get fudges from these central bankers, and we're probably going to end up with interest rates at more or less the current level, which is the level they've been, roughly speaking, for the last 300 years, with the exception of the negative interest rate period. Those interest rates are not high enough, however, to get rid of the genie of inflation, which once out of the bottle will probably persist for a further few years at 4, 5, 6%.
Well, indeed, and central banks have to cope with the risk of financial instability. So if rates go too high, too fast, that risks some kind of systemic banking crisis.
Yeah.
And we've already seen what happened to Credit Suisse and Silicon Valley Bank, which arguably is idiosyncratic. There were particular factors involved, or specific factors there. But we're at an end of a cycle. Rates are not likely to go down now, are they? I mean, the IMF thinks, weirdly, that rates are going to go back to zero at some point in the medium term.
Well, they might, you never know, they might get one of their forecasts right. But let's put it this way. In the modern era, the IMF has had less than a 10% strike rate in terms of its forecasts being accurate. So I wouldn't put too much faith in the IMF. And the reason is because they're so bureaucratic, they take 6 months to review any forecasts they're about to make.
Indeed.
So they're always out of date, always wrong, always behind the curve. Do the opposite of what the IMF suggests, in my opinion. Yes, so interest rates are normalizing as they should, but they're not at the Volcker type of level where inflation is going to be sufficiently tamed. And that means that for the next 5, 10 years, possibly, we're going to have fairly persistent inflation. That lends itself quite well to value stocks and to cyclical stocks, believe it or not. And it certainly lends itself to a commodity cycle that is ever upwards. And one of the things I should have mentioned there was that my big recommendation last year was buy gold. And that is still a massive recommendation of mine for different reasons that I'll explain later on, Victor. Mm-hmm. Gold is an integral part of anyone's portfolio, conservative or aggressive. Whatever way you're positioned, you should have some gold. Mm-hmm. Very important.
It's you say that the inflationary genie is out of the bottle. So we've got to live in an inflationary environment for some years to come. Now, there are pros and cons to that, aren't there, Jim? I mean, it's quite good news for governments who can inflate their debt away to some degree. But in terms of living standards, maybe wages are not going to grow as rapidly as prices. And therefore, you see the cost of living crunch perpetuating itself with all kinds of unpleasant outcomes like strikes and widespread discontent.
Well, I mean, I can't disagree with that, but I will say that we do have very low levels of unemployment. And typically at this stage of the cycle, you'd expect there to be relatively high unemployment. Many people have withdrawn in their 50s and 60s from the labor market. True. That's one contributing factor to it. But we have actually now got a job system where new types of jobs have been created that are much more flexible, and as a result, we have relatively low levels of unemployment. We also, in this country, have 5 million people on welfare benefits, which is far too high. And I'm not saying cut the welfare benefits or get people off welfare, but retrain them. Find a way of putting these minds that are not being used to the economic purpose, and also to create the societal structures that Richard Marshall was talking about in Juvenescence that keep people alive longer. If you're sitting at home watching daytime TV, which, by the way, I quite like sometimes, my favorite is Flog It. If you're sitting at home watching daytime TV all day long, you're probably going to die younger than if you've got a purpose. You get up and you go to a job or you do something that's productive. And so we need to get these people back into work. We also need migration into this country. We will not grow unless we have migrants coming in. And so, although there are plenty of problems with migration and there's lots of contentious and so forth things, why are we keeping migrants in hotels and hostels when they should be doing courses to learn something that they can do and work in the workforce?
Most people would agree with you, Jim, that skilled migration is a benefit. But if it's unskilled, that might be a different matter.
Well, I disagree with that, because actually most of the migrants who come in are young, are healthy, and they can learn. And if we gave them some training, then I think that not everyone in the world can be skilled. some people have got to do jobs that are not particularly well skilled, but they need some training for that. And I think we should be providing for that. And we shouldn't have people just sitting in hotels all day long. But that's a side issue. The main issue is what's the best place to invest, right, Victor? What is the best place to invest? What's your number one recommendation?
Well, I think India is very interesting.
Oh, yeah, I agree with that.
I'm concerned about China. As you know, we've discussed in the past, there are corporate governance issues, and I think the entire economy is manipulated by an authoritarian state. I think the US market appears to be going sideways. The UK market, well, as we discussed the other day, most of the return is in the dividend rather than in the capital gain. Particularly in terms of the FTSE 100, you have a lot of mature companies, mining stocks, and mature industries of one kind or another. What is the most exciting market for you?
Well, I wouldn't say it's necessarily exciting, but I'm like I was this time last year. I'm quite bullish on the UK market because the US market is between 18 and 19 times earnings. Corporate profits in the United States are about 15% of the economy, $3 trillion. That figure is falling. Corporate profits have grown really exponentially at the expense of workers' remuneration. Now workers' remuneration is going up because of the pressures that you mentioned earlier on, and there are cost pressures for companies. So it's important to recognize that the PE ratio of the US, which is, as I said, 18 or 19, at a time of falling corporate profits, at a time of rising or risen interest rates, is too high. And so generally speaking, I would avoid the United States. In the UK, our FTSE 350, which I think is a better representation of the broad spectre of the UK economy, is somewhere less than 11 times earnings and will probably eke out some earnings growth. Now, the other one thing I want to talk about is that if you're an international investor and you invest around the world, you will get hit on dividend withholding taxes, which probably most people don't take any countenance of. But if you're investing for dividends, then you could be hit with 35% withholding tax in the United States, 30% in Japan. Across the European Union, it varies. In this country, there is no dividend withholding tax for international investors except for property companies, which form a relatively small part of our market. That's a major attractive feature. So companies like BP, Shell, and so forth, the dividends are being received gross by international institutions. That's a positive factor for our economy. Forget about all the stuff, Victor, about the fact the French stock market is bigger than the UK stock market in market capitalization. It doesn't matter.
Quite significant.
The city is 25 times bigger than Paris in terms of its economic power, and that's the important thing. The size of the stock market is almost irrelevant. We are 1/20th or 1/15th the size of the US stock market, but London is the equal, if not greater, than New York as the financial powerhouse of the world. The stock market is not relevant, and taking Paris as an example is because everyone is buying, particularly in China, Louis Vuitton handbags, and that's why LVMH is a huge company and a big factor in the fact that Paris is a very big stock market. But that's a total distraction. There are some great companies in this country. I'm not suggesting you have all your money in this country, far from it, but I do think it's probably going to be the best developed market, stock market, maybe with the exception of Japan, in the next year or two.
But Bernard Arnault is the richest man in the world, is he not?
Well, it varies from day to day.
Indeed.
He's much better dressed than Elon Musk, let's put it like that.
True. Or than Zuckerberg. Can we talk about growth in this context, Jim? At least America seems to have a growth mojo. I mean, it's going to grow at something like 1.8% this year.
Is it?
Depending on which forecast. We don't trust the IMF.
No.
But it seems that America has more of a dynamic growth outlook than either Europe or the UK. And correspondingly, you see the outlook for China is much more conservative than it used to be. China is not going to be growing at 8 to 10% every year. Indeed, India is likely to grow faster than China.
I agree with that. So I agree with that. I think India is a coming place and absolutely should be a part of everyone's portfolio, but it's not a cheap stock market. No. China is very cheap, 7 or 8 times earnings for the leading Chinese shares. But for all the reasons you say, although China is the second largest economy in the world, it shouldn't be the second biggest part of your portfolio. I think the US will be in recession by the end of this year. I think profits will come down. I don't think the US is going anywhere fast in terms of its stock market performance. It may be even going down. So I would just be wary about having a hefty exposure to the US. It is a growth center, though. In terms of the new industries, it's where the innovation occurs.
The technology that we're going to talk about. Just very quickly, does it matter who is in the White House as to the upturn for the US economy?
Well, it certainly matters to them. They certainly cling on to power, don't they? Look, I don't know. And I always think it's wrong for us who are not Americans to be commenting on, which president they should have. But I have no idea who's going to be the president. Do you? Who do you think will be?
Well, I think there's a strong chance that it won't be Biden and it won't be Trump. Let me put it that way.
Right. Can you give us a name?
Well, it could be.
I'm going to go and put a bet on.
I guess the Florida Governor DeSantis is the front runner.
Yeah.
Now, but it could change. We shall see. Do you want to talk about technology? Yep.
Yeah.
I think you have a slide in which you've got 4 major fields, if I can put it like that, where mankind is making very rapid advance. And I think one of them was in terms of quantum computing and AI.
Yeah. I'll put that up in a second. Yeah.
Yep. We'll come back to that. The other one is, well, there are 2 fields in which you are invested and in which I think I can call you an expert. I mean, you once told me that the field of longevity science was one in which you had moved the dial to some degree.
No, that we would move the dial. That is the company that I was a co-founder of. I'm a co-founder of. And we've got Richard Marshall on his stand here today from Astra, brilliant guy. Mm-hmm. Was one of the guys who developed the Oxford vaccine. And I think that you should go and talk to him if you've got time afterwards. All of you. I mean, anyone who wants to go and talk to him. So, yes, I think that...
There's agriculture, the new agricultural revolution.
Yeah.
And I haven't got the slide in front of me, but there was another field. Just parenthetically, you have been quite down on technology stocks.
On the FANG stocks, yeah.
But for a while.
Yeah.
But I think you came to the conclusion, didn't you, that there are technology stocks and... There are technology stocks, it's not one thing.
Well, almost every company now is a technology company because they employ it as a part of their business process. Even steel companies, you could say, are technologically driven now. It used to be very easy between a cyclical company and a technology company. And obviously you would invest in the technology company if you were seeking growth because technology is seamless in all of our lives. But I want to point out this slide, the 30 under 30, the opportunities to lose lots of money in technology are there. And, just think about the WeWork fiasco. Think about that guy from FTX, Sam Bankman-Fried. And think about how much money has been lost as a result of their antics. I don't know how much he's taken down.
Can I ask you, Jim, were you ever exposed to crypto?
No. Look, let's put it this way. In the last year, gold has gone up. I think everyone knows that. Gold is going to go up further for reasons I'll talk about in a second. Crypto has halved. Which one is the better store of value? I think it's gold. And there is a very compelling reason, the end of US dollar dominance, that's coming to hold gold in your portfolio.
Okay. Shall we talk about juvenescence and longevity science?
Yeah, so let me just talk about first, Victor, how inventions that seem obvious take a long time sometimes to get commercialized. So I want to talk, for instance, the can opener was only invented 48 years after the first can. So you might ask the question, well, how did they open the cans? They literally used a hammer and a chisel to open the cans in the early days. So someone came up with a can opener 48 years later. The steering wheel was only invented 8 years after the first car went on the road. And what's this one here?
I think they had a trailer.
It took 30,000 years before someone worked out that you could actually slice bread and have prepackaged sliced bread. So, things that seem obvious may not be obvious at the time. It is with the science of longevity and with agricultural change and so forth. these changes may appear to be under the surface. Where is the pill I can take to keep me alive for another 10 years? Where is it? Well, it's not here yet, but if you can stay alive for another 10 years, there will be such a pill or a combination of pills and therapies that will keep you alive for another 10 years. So we're very close to major inflection points in some of these key technologies, but don't be put off by the fact that there's nothing obvious today. The internet, when it first came out, you remember, like I do, the dial-up phase of the internet. What was it for? Couldn't work out what was it for. And now we can't live without it, right? So in 20 years, the internet has become probably the most important technology on the planet.
Yeah, totally.
But it wasn't obvious when it first came out. And so it is with the new technologies that I'm investing in at the moment. So 2 pots. One is your long-term, money fountain type money that you need to make some investments in. And we'll talk about that in a second. And the second is, what do you do today? And today, there's some recommendations I've got. And if you want the full slides and so forth, just ask for them later on. We won't go through every single slide.
On juvenescence, longevity, and I do understand that the idea is not just to prolong the human lifespan, but the so-called human health span. In other words, to cut out the degenerative diseases of old age so that we live into our 90s, hopefully without getting dementia, without getting arthritis, and so on and so forth. Now, most of us are keenly aware, you only have to you look at the Saturday and Sunday supplements.
You were saying looking at the audience.
But this is an intelligent group of people. Nutrition, exercise, good habits, good sleep, that means we're all going to live longer. Can you just give us an example of a medical technology which is imminent, which is going to prolong our lifespans? I mean, is it a pill? Is it a dietary supplement?
It's a combination of lots of things. And Richard Marshall of Juvenescence is able to give you the kind of the lowdown. And for those who were in his speech, excellent speech, you'll have heard that. So basically, one example would be the regeneration of tissue.
Yeah.
And we are now in a phase 2 trial with our company Genesis, where we're regrowing liver tissue in situ, in the body itself. It's a very cheap procedure relative to a transplant. It's something like, I think, $15,000 cost versus $800,000. It means that the number of livers that are being donated, which means dead motorbike people, can be vastly expanded over the number of people who are waiting for liver transplants. And if it works, then other organs can be regrown in the body as well. And this is super exciting. So we're like classic cars. Parts of us will be replaced using our own bodies.
Jim, sorry to interrupt. Does that mean that transplants will become redundant?
No, because it can only apply to patients who, to certain subsections of patients.
Yes.
But there are hundreds and hundreds of thousands of those who can't get a liver transplant for whatever reason. There are millions of people on dialysis who are waiting for kidney transplants.
Yes.
Diabetics who have type 1 need islet transplantation, which is coming, by the way. So there's, there's great hope. But again, give it 5 years, and then it will become a regular procedure. But, it's not going to completely displace the transplant market. And hearts, by the way, they will have to be heart transplants.
Those will continue.
Yes, yeah. And lungs, yeah.
I know in your book, the one that I have read, Juvenescence, you describe in great detail and with fascinating insight telomeres and these genetic carriers of information and how they can be modified such that you can possibly reprogram them so that they don't die off as they are programmed to do at a certain time of life.
Yeah.
Do you think aging is in fact pre-programmed into our genes?
No, but we're exposed to all sorts of things. As Richard put it, you lose your homeostasis as time goes on, because it doesn't matter if you sit in a cloistered room with pure oxygen and you never smoke, drink, eat badly, and do anything that might put stress on yourself. You're still going to get out of balance eventually. it may just be delayed. And once you get out of balance, you get one disease, then 2, 3, 4, 5, 6. So the real key is to prevent people from getting that first disease of aging.
Right.
And then they don't get the cascade of other diseases that follows. And that's what they're working on.
If you can avoid the hypertension, you avoid the follow-up disease.
And there is no reason why everyone in this room shouldn't avoid hypertension. You know, we should all be on statins at the age of 40. Yes. We should maybe even be on blood pressure medication. Cardiovascular disease should be a thing of the past, but it's still the biggest killer in the world. Cancer is fast becoming a thing of the past as they get more and more personalized medicine for it. And dementia, even though you mentioned it earlier on, there are less and less, the percentage of people getting dementia is less and less, even though the number of people getting dementia is more because there are many more old people.
Yes.
Yeah. So don't worry. There's no evidence that you're in any way on that path.
Thank you. But indeed, it does seem that in terms of cardiac disease, the rate of mortality has declined already over the last 30 to 40 years.
It has. And, you know, if you haven't got one, invest in a defibrillator at home, because if you have a heart attack outside of a hospital, there's a 90% chance of mortality. If a defibrillator happens to be there, your chance of survival goes up to 65%. So why wouldn't you have a defibrillator at home? I'm not invested in a defibrillator
How
company.
many people have a defibrillator at home? Only a few.
Right. Okay, we should invest in a defibrillator company.
So there is a huge potential market for domestic defibrillators.
Definitely.
Jim, that is one pot of technologies, of the medical pot of technologies. And by the way, you organize a symposium every year of medical scientists who are preeminent in this field, which is itself a scientific event. Can I talk about the other pot of technologies, which is going to revolutionize agriculture? And that's the subject of this book. Now, Anthony Chow of Agronomics made a wonderful presentation earlier. Mind-blowing stuff. There is like precision fermentation and cell-produced meat.
Yeah.
And these things are actually happening already. Now, I just have a simple question for you, Jim. Why is it that those plant-based meat substitutes or alternatives bombed? I'm thinking of Beyond Meat, which basically was launched with great fanfare, and the share price went from something very high to something very low. And it doesn't seem to work as a commercial proposition. But lab-based meat, which is what agronomics is all about, is a completely different concept and has a different... Can you just unpack that for us?
Yeah. Okay, so plant-based is a substitute, a synthetic type of meat that is typically highly processed, doesn't taste like meat, at least as I remember meat when I used to eat it, and doesn't look like meat it doesn't have that same characteristic. The stuff that's produced in the lab, and be it dairy products, egg products, meat, fish, leather, is the real product, because it comes from the stem cells of animals that have not been slaughtered, but it produces the exact same meat without antibiotics, hormones, environmental damage, and animal cruelty that you get by intensive farming. We are not anti-farming, we're against the process of intensive farming. There is a so-called hog hotel in China with 1.3 million pigs in it, right? They're all in very close proximity. They're all being fed antibiotics. 80% of the world's antibiotics goes into farmed animals, intensively farmed animals. Yep. That produces antimicrobial resistance in us and could lead to a bacterial pandemic if we're not careful. Don't laugh about it. We've just had a terrible pandemic. We could be even worse if we had a bacterial one. The damage to the environment of this intensive farming is absolutely enormous. It's about a third of all emissions around the world. Water resources are being plundered to provide the 10 billion animals a year that are slaughtered every year around the world. Mm-hmm. Whether you're for farmers or against farmers, we need to chip away at the edges of this because it's unsustainable. So this is the solution. Precision fermentation first, then cell ag products And as you rightly point out, it's not science fiction, it's here and now. Every single company we've invested in agronomics, has a product. And some of those products are going to be at scale in the next 2 or 3 years. All of them have a dramatically lower environmental impact, and they have the potential, not just potential, they will be cheaper in due course than the conventionally farmed meats and fish that you're familiar with, because the protein to protein input is so much lower than it is for conventionally farmed animals. So it's super exciting. Anyone who doesn't have an exposure to this sector is mad, in the same way as if you don't have gold. And I've never sold a single share. I really believe that this is impact. You talk about turning the dial. This is impacting the world in a positive way. Most people don't know about it, therefore it's undervalued. It's completely different to the plant-based stuff you talked about.
Right. I think on one of Anthony's slides, he was saying that the economics of lab-produced meat will converge with those of conventional meat by the end of the decade.
Yes, and go down from there.
Because one of the principal costs is obviously energy costs. That the process is becoming more efficient. And so it might be skewed if energy cost goes up, but that affects conventional farming as well, doesn't it?
Yeah, I mean, energy is an important component, but it's not the most important one. The most important one is the amount that the animals eat. So a cow takes in 25 times more protein than it puts out over the course of its life cycle. 25 times.
Yes.
On this, as Anthony said in his talk, it's 2 to 1. So the chance of, I launched my new book last week, and the chairman of Tesco was in the audience. Because, and this was on the subject
yes.
Of this, what we're talking about, because these big supermarkets recognize this is the way of the future. If they want to be net zero, green companies, responsible people on the planet, they need to do this. And so this won't be the Beyond Burger that you occasionally eat. This will be your daily protein eventually. But it's going to be a long, long time in the making, and hence the opportunity.
Will conventional farming go by the wayside completely?
No. What we want to do is to get rid of the cruel, intensive farming, largely practiced in the US, not so much here.
And China.
And in Asia.
Yes.
I didn't want to say China specifically because
okay.
You never know who's watching.
Okay.
Right.
I mean, some of us who do still eat meat discriminate between, farm-reared, grass-fed cattle who are raised with a high standard of animal welfare and the factory farming stuff.
Yeah, carry on.
Yeah.
Carry on. But, this stuff is not going to be your steak
yes.
That you get in your lovely restaurant near your house. So this is the stuff that goes into McDonald's burgers or goes into sausages or pasties or that sort of thing, because the consumer doesn't see it. All right?
Right.
So it's meat, but it's not visible.
So there will still be a market for luxury Wagyu beef.
Don't worry.
Yeah.
There will be.
Okay. Okay. Jim, because we're into our last 5 minutes, I just wondered if we could see your stock tips.
Yeah, right.
I think there's 20 or so stocks. And also, we were keen to see your model asset allocation strategy.
Yes, right. Which I'm going to have to make one alteration to because we couldn't alter the slides here.
Okay.
So I just stand up for this. Right, no, this is more sell ag stuff. This is Juno's Arc. This is the new book that was launched last week. Every penny of the money, and so they're only £8, goes to animal charities. And Juno, this is a replica of Juno, the dog, was here in Oxford last weekend as she launched her book. If you go to the stand at the back over there, please buy books because all the money goes to charity. It's a lovely children's story. I even persuaded Victor to buy one of the books. And the person who buys the most books today, someone bought 100 copies yesterday, will get a bottle of best English champagne. I think it's called Gisborne.
Oh, lovely.
It's like £100 a bottle. Comes from my personal wine cellar. And you can open it on the coronation, which is in 3 weeks' time.
What
so
a good
please
idea.
buy this book. So that was a little interlude for the charity.
I'm told by the day that the Juno in question is the most spoilt dog in Spain.
She's not spoilt at all. But I have to say, she doesn't do much work, except looking after the pack. We have 7 dogs, by the way. So, all right. So first thing is I want you all to buy gold. derivatives, gold bullion, gold companies, gold whatever, or silver, or platinum, doesn't matter. The reason is that in the last year, SWIFT, the US dollar system of payment, has been to a certain extent weaponized. If you're a bank in Belarusia or Saudi Arabia and they take against you, they can stop you from using the system. The second thing is that, as we know, and rightly, I'm not disagreeing with this, they froze a lot of the Russian foreign exchange assets outside the country. So if you're an autocrat or you're worried about where your money is going to end up, you start thinking about, well, do I want it all in the US treasuries sitting in New York? No, probably you want to diversify. That's why the central banks are all buying gold. They will continue to buy gold. They're not going to buy cryptocurrencies, they're going to buy gold. You must have 20%, in my opinion, of your assets in gold for the next year, and I forecast that the price will go up by at least 20%. It's just at its all-time high, or very close to its all-time high. When it goes through it, it will slice the knife like butter, or it will be like a knife slicing butter. So that's the first thing.
Jim, should we get exposure to gold by buying gold miners or by buying?
I think you choose your poison, okay? But there's plenty of ways of buying gold. There's some gold companies here. You've got Condor, you've got Dart, you've got a number of other gold companies here you can talk to. So please, get your, you're not going to make a fortune out of it, but it's going to preserve your wealth. And in these uncertain times, that is important. The second thing is, where do you put your currencies? Well, in the last year, the US dollar has been showing signs of rolling over. It's fundamentally overvalued. It's losing its dominance. Not all payments are going to be made in US dollars. 80% of trade is now paid for in US dollars. So what's the best currency for the next year? I would say, if you can, buy the Japanese yen. Because the Japanese are going to have to change their monetary policy. It's all very complicated. But generally speaking, I would say the yen at about 133 to the US dollar will go to below 120. That represents a fantastic return. You don't get much interest on Japanese yen, if any, but it represents an excellent return. So Japanese yen as your currency play. In terms of allocation, well, hold some cash, have some emerging markets. I think emerging markets look really attractive relative, particularly Asian markets, relative to developed markets, with the exception of the UK. I'm not that keen on fixed income, but for a conservative investor, probably looking for an income, there are opportunities in bonds now, whereas there were no opportunities a year or two ago. So you can have some money in fixed income or quasi-fixed income type investments, like oil stocks that yield a high yield. And by the way, I think the price of oil will go back up, so bear that in mind. And then, some in Europe, a small percentage in the United States, in my opinion. But basically, be long gold, be long commodities, be long the British stock market, particularly if you're UK-based. Be long value stocks relative to growth stocks over the next year. Be long the Japanese yen, and you'll do just fine. So that's my recommendations. And we've got some stocks here. I'm not going to go into detail on any of these, but some of the companies are represented here. Most of them are not. But for various reasons, I like all of them, and you might want to take these into consideration when constructing your portfolio. As I said, all the slides will be available to people after Victor and I have wrapped up, which is in a couple of minutes. So I am working on a new book. The area that I'm really interested in, which the UK is a world leader in, is fusion. Right?
Very interesting.
And so by the end of this year, hopefully I'll have a new book. But in the meantime, for the sake of the dogs, for the animals, for the sake of me, my Amour prop, having written this book, and for the sake of Juno, the dog, go buy lots of books and get a bottle of champagne from me.
Jim, last question. What do you say to the people who say that if nuclear fusion was going to happen, it would have happened already? It's been about to happen for about the last 40 years.
Yeah, Winston Churchill said in the 1950s that there would be chicken made in labs, and it took 70 years for that to happen. So nuclear fusion has been a bit like Brazil. It's the coming technology, the coming country in the case of Brazil, but it's never really happened. However, for the first time ever, we got more electricity out of a generation process in Lawrence Livermore in the United States than was put in. Admittedly, the figures were somewhat fudged.
For a microsecond.
It doesn't matter. This is nuclear power at its best because there's no radioactive waste, there's no danger of everyone blowing up. I mean, I cannot believe the stupidity of some countries. Germany, as an example, today is switching off its 3 remaining nuclear reactors. And yet, it's opened up, again, those horrible brown coal plants to provide the electricity that's not provided by the 50% of renewables and by gas. It's absolutely crazy. We in this country have a better mix, and we are going to be building small nuclear-powered reactors. Hopefully Rolls-Royce will be doing that. Good company, by the way, Rolls-Royce, I think. But we need to invest in fusion, which we are a world leader in. Don't let's miss this opportunity. Look it up. Read my book when it comes out, hopefully, and I don't know which charity. Is there a nuclear charity I can donate to?
No.
But some charity will be the beneficiary of that. But please, have a look at this stuff, because this is the future. Remember, eat today by investing carefully in your regular portfolio. Eat really well, like a king or an emperor or King Charles, by investing in money fountains of the future. And I've got a few here for you, but there are others out there. But whatever you do your reading, do your analysis, find a good manager that you can trust. If you're good, the investment trusts, by the way, of this country are generally brilliant because they have very low costs and really good management. So look at investment trusts as one place to put your money.
Jim, I don't know about you, but I could continue this conversation for another hour, but sadly, we are out of time. You're signing books, aren't you?
Am I? Okay. Yeah. If anyone buys any,
Yes.
I'm not going to go to the signing yet, because if no one buys any books, then I don't want to look like the sad guy, waiting for his fans to come. But I really appreciate everyone coming today. It's really, we're back to kind of normal. It's been, a tough 3 years, but it's really fabulous to see so many faces. And Victor, as always, you guide the conversation brilliantly. I want to ask you one question. What's your number one tip for investment in the next year?
Oh my goodness. I would say look at the value of something which is not being made anymore, and that's land. And agricultural land, I think, is a very interesting sector.
Okay.
Something I've been looking at. Jim, thank you so much for coming to see us today and for a fascinating talk. And ladies and gentlemen, a big thank you to Jim.